We are currently witnessing one of the most massive structural market pivots of the decade, and it is hiding right in plain sight. Let's examine why the broader market might be mispricing this transition entirely.
Welcome to this explainer. Today we're unpacking POSCO Holdings, trading under the ticker PKX. Now you probably already know POSCO. For decades, they've been known globally as a legacy South Korean steelmaker, a true cyclical heavy industry giant. But right underneath that legacy exterior lies a classic sum-of-the-parts deep value opportunity. When we talk about a sum-of-the-parts play in institutional finance, we're looking at a scenario where the individual pieces of a business are actually worth significantly more than the current valuation of the whole company combined. POSCO is aggressively transitioning from traditional heavy industry into an absolute powerhouse for green energy and rechargeable battery materials. And today we're going to unpack exactly how they're executing this massive pivot and why Wall Street's surface-level models seem to be completely missing the underlying math.
The mechanics of this transition are hiding right there in the revenue breakdown. Look, steel is absolutely still doing the heavy lifting here. It makes up roughly 55% of their total revenue and serves as the legacy cash cow. Infrastructure, which covers construction and energy, sits at 25%. But the real star of the show, the future growth engine, is that 20% slice dedicated entirely to rechargeable battery materials. POSCO is pulling off a brilliant balancing act. They are deliberately taking the massive cash flow generated by their traditional, mature steel mills and using it to self-fund a hyper-growth battery business. It's essentially old economy capital paying for a new economy valuation multiple.
And because of this shift, POSCO's economic moat is undergoing a total evolution. Historically, this moat was built purely on the sheer scale and cost advantage of their Gwangyang and Pohang facilities. They are literally among the most efficient integrated steel mills on the planet. But looking forward, they are building an astonishingly wide advantage, an end-to-end vertically integrated EV battery supply chain. By securing raw lithium and nickel directly from their own assets in Argentina and Australia and controlling the processing all the way down to producing the final cathode and anode materials, they're fundamentally changing their margin profile. Owning that entire life cycle protects them from the volatile price spikes of third-party raw material suppliers. That creates a defensive barrier that pure-play battery producers simply cannot replicate.
Now, when you translate that structural shift into the hard financials, you start to see exactly why the broader market is so confused right now. If we analyze the 5-year trajectory, revenue is actually compressing. We're looking at a drop from 84.75 trillion Korean won in 2022 down to an estimated 69.09 trillion by 2025. Operating profit is following a similar downward trend. This represents the severe cyclical compression POSCO is fighting through. The traditional steel sector is being heavily pressured by global macroeconomic slowdowns, sluggish global steel demand, and wildly fluctuating mineral prices. All these headwinds are just squeezing their legacy margins. And honestly, this top-line decline is the exact reason the market is mispricing the stock. Algorithmic traders and surface-level screeners see a shrinking legacy industrial and they just hit sell. But by stopping at the top line, they're entirely missing the aggressive high-margin internal restructuring happening right below the surface.
Because behind those cyclical headwinds, management is executing an absolute masterclass in capital allocation. POSCO maintains an incredibly healthy balance sheet, they are hyper-focused on cash generation, and they're actively offloading non-core and low-yield assets. By targeting a massive 3.5 trillion Korean won in cumulative free cash flow by 2028, they're establishing a fortress of liquidity. The strategic brilliance of this really cannot be overstated. In an era characterized by higher global interest rates and very expensive capital, POSCO is completely self-funding a multi-billion-dollar battery materials transition without having to over-leverage the company with dangerous amounts of debt. They're essentially paying for their own structural evolution through sheer operational efficiency.
The critical inflection point arrives when all of this internal preparation finally meets execution. And that brings us to the massive catalyst that just materialized, the Q2 2026 earnings surprise. PSCO reported a Q2 earnings per share of $1.30. To really understand the gravity of that number, consensus estimates were sitting way down at 85 cents. A 45-cent beat on an 85-cent expectation is an absolute blowout. That's over a 50% beat to the upside. Furthermore, total revenue came in at $12.43 billion, easily clearing the street's projections. This wasn't just a slight cyclical uptick, right? This was a fundamental signal broadcast to the market that the underlying mechanics of their business model are finally shifting into a significantly higher gear.
The actual origin of that massive earnings beat is exactly why Q2 2026 is being universally viewed as the ultimate turning point for POSCO. For the very first time ever, POSCO Argentina's lithium operation achieved a quarterly operating profit. Getting to this point required enduring immense pain. We're talking 8 consecutive quarters of operating losses as they poured billions into capital expenditures to scale the operation. The market has spent the last 2 years aggressively pricing in that CapEx pain. But what the market hasn't yet priced in is the reality that the broader rechargeable battery segment has finally returned to a surplus. The transition is no longer just a narrative built into some forward-looking presentation. It's bearing fruit. The lithium is flowing, and it is officially profitable.
Now, to maintain an impartial, institutional-grade analysis, it's vital we weigh the massive competing macroeconomic forces acting on this stock right now. On the tailwind side, the geopolitical landscape offers an enormous advantage through the U.S. Inflation Reduction Act. The IRA heavily incentivizes EV supply chains that operate entirely outside of China. Right now, global automakers are absolutely desperate to secure reliable, IRA-compliant battery materials so they can qualify for consumer tax credits. Because POSCO secures its lithium from Argentina and hard rock assets in Australia, they stand as a prime, fully compliant supplier for Western automakers. That is a gigantic structural demand driver. However, on the headwind side, Chinese structural steel overcapacity continues to result in the dumping of cheap steel onto the global market. This effectively caps global steel pricing, keeping a very tight lid on POSCO's legacy margins.
And this tension brings us right to the core investment thesis, the valuation disconnect. The contrast between how POSCO is priced and how its peers are priced is just stark. POSCO is currently trading at a forward price-to-earnings ratio of roughly 11.8. Meanwhile, pure-play battery materials companies, businesses executing the exact same operations as POSCO's battery segment, are trading at an average forward PE of 30, with some even pushing up toward 40 times forward earnings. The market is entirely valuing POSCO as a sluggish, mature steelmaker. They are receiving virtually zero premium for the fact that a full fifth of their revenue stream is generated by a hyper-growth, highly profitable, vertically integrated EV battery supplier.
This dynamic sets up a highly compelling re-rating thesis. A multiple expansion in the near future is highly probable. As Plant 1 in Argentina returns to full optimized operation and Plant 2 rapidly ramps up its commercial capacity, the battery segment is going to begin contributing a drastically larger percentage of total operating profit. The mechanics of a re-rating happen when institutional capital finally recognizes this shift. As ESG and growth-oriented funds realize POSCO is essentially a battery company wrapped inside a steel company's valuation, capital rotates in, forcing the valuation to transition from a suppressed 6 to 8 times steel PE toward a 15 to 20 times materials PE. For the patient investor willing to front-run that institutional rotation, this structural re-rating presents a highly attractive 3 to 5 year wealth creation window.
Let's rapidly walk through the fair value scenarios presented in the institutional research because it really highlights the asymmetric risk profile. The base case puts the target at $95 to $105, assuming steady steel margins and a moderate EV materials ramp-up. If a global steel pricing recovery aligns with POSCO dominating the ex-China EV supply chain, the bull case points to a massive upside of $130 or higher. The bear case sits at $60, assuming a deep, prolonged global recession and a strict plateau in EV adoption. When you contrast that immense upside potential of $130 against the relatively well-protected downside of $60, the risk-to-reward ratio becomes extremely clear. This asymmetric profile is exactly why institutional smart money is already quietly accumulating shares during macroeconomic dips, treating this as a premium, ESG-compliant, deep value asset.
For those of you observing the technical macro view, the entry strategy suggests accumulating right in that $70 to $85 range. The stock has been attempting to break out of a multi-year cyclical base, and there is major structural support sitting rock solid right in the $65 to $70 zone, with resistance up at the psychological $100 to $110 level. Further protecting your downside here is the company's aggressive commitment to shareholder returns. POSCO has pledged to retire 6% of their treasury shares over 3 years. Remember that massive 3.5 trillion won in free cash flow we discussed earlier? They are using that to actively shrink the public float. This artificially boosts earnings per share and adds a really heavy layer of structural support right beneath the stock price.
However, sound analysis demands we clearly outline the primary execution risks. No structural transition is without them. First, a prolonged slowdown in global EV adoption could drastically delay the payback period for POSCO's aggressive multi-billion-dollar capital expenditures.
Second, mining and processing lithium is highly complex stuff. Any execution or engineering delays in ramping up their Argentina brine or Australian hard rock operations could immediately damage operating margins. Finally, there are severe safety and governance risks to monitor. The group recently reported a fatality at POSCO E&C. In modern institutional investing, ESG flags like a workplace fatality can trigger strict regulatory scrutiny and automated sell-offs from algorithmic ESG funds, making this a very real threat to the stock's momentum. These risks must be weighed carefully against the overarching growth narrative.
So synthesizing all of this data, the overarching takeaway is undeniable. POSCO Holdings is a classic, textbook, sum-of-the-parts deep value play, undergoing a monumental structural transformation. The market's institutional muscle memory is still stubbornly pricing POSCO as a cyclical, mature steel mill, but in doing so, the broader market is completely ignoring the reality that POSCO is rapidly becoming one of the most comprehensive, vertically integrated EV battery material suppliers anywhere outside of China. They have an ironclad balance sheet, aggressive share retirement shrinking the float, and a clearly funded, debt-free path to immense structural growth. Which leaves us with this final thought. Look at the data, observe the execution of this transition, and ask yourself, is the market entirely mispricing the greatest EV supply chain transition of the decade?